Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the 10 most popular funds on the AJ Bell Invest Centre platform right now, namely M&G Strategic Corporate Bond. With regard to the fund's mandate, it's the job of highly experienced and equally highly respected Richard Woolnough and team to generate a positive total return through a combination of capital growth and income by investing in a portfolio of primarily investment-grade corporate debt securities. As we can see from this first graphic, 83% of the assets are in investment-grade paper, 9% in high-yield or junk bonds, and the rest split across govies, government bonds, and then cash. The £3.9 billion collective offers a well-diversified portfolio with around 530 holdings as I sit here, and advisors and clients' capital is put to work across a wide range of geographies and sectors. This second graphic shows the country mix, with the British and American corporate debt markets representing by far the bulk of the portfolio. And this next one shows the sector exposures. Here, securitized debt and then bonds issued by banks and telecoms companies are the three biggest positions. Note that the average credit rating of the portfolio is A-, and this bar shows the distribution of the portfolio by credit rating, with less than 10% coming in the BBB- threshold, which separates investment grade from high yield. The current yield on the fund is around 2.9%, and although we're looking at the accumulation units here, there is an income unit option if you want it, and that pays out dividends 4 times a year. The ongoing charge figure for this share class is 0.66%. The fund is eligible for all wrappers, and for those who put faith in such things, the fund has a 4-star Morningstar ranking. So those are the mechanics. The question to address next is why would advisors and clients be buying right now? And I think there may be 2 possible reasons. The first, well, it's that 2.9% yield. US interest rates have been increased twice, but the US Federal Reserve's target range is still only 0.5 to 0.75%, while the last move in the UK was down to 0.25%. As such, many clients will still be looking for some kind of dependable yield, and investment-grade corporate debt might just offer the sort of risk-reward balance that's acceptable to some in this context. Second, interest rates may be rising slowly, but they are still rising in the US, even if interest rates are not budging in the UK, Eurozone or Japan. And anyway, government bond yields are going up. Doesn't matter what the central banks are doing. And here's where a strategic bond fund can add value. Following the election of Donald Trump as US president, growth and inflation expectations have started to rise, and that's equally dragged bond yields higher. Now that's not always great news as bond prices fall as yields rise, but this is where a well-run strategic bond fund can add value by providing capital protection too, and they can do this by holding shorter duration assets. M&G Strategic Corporate Bond can be flexible about where it invests, and right now, Woolnough and his team are running an average duration of 5.6 years. That's probably why the fund has shot from being third quartile 6 months ago to top quartile now. Of course, the risk is that the fund manager has the wrong duration or is overweight the wrong sub-asset classes or geographies at the wrong time. So advisors and clients will still need to do their homework and ensure that the fund fits with their overall strategy, target returns, appetite for risk, and time horizon before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.